When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management in Tucson and Mesa. Hey, Jeff, how you doing today?
I'm doing great. It's always fun to be with you on the weekends and with the listeners and get all this stuff I've built up all week off my chest.
I know we're going to give you a chance to vent here, Jeff. Let's get to some of the things at hand here, current events. It occurred to me, Jeff, that, in the past couple of weeks and in the last 60 days or so Donald Trump has been in office, he has made some moves that are rather unconventional, and I think people are not quite understanding those. So with that in mind, can you give me your opinion on these unconventional moves? And he just really doesn't operate like the regular politician that we're used to seeing, and I think many times people are not seeing the forest for the trees here. What do you think about that?
Well, it's true. And I think you've really got the the establishment all bent out of shape for sure. I mean, they're beside themselves. Their gravy train's going to end. They've got Doge looking into the corruption and all the side deals and the kickbacks that's going on behind the scenes. Companies are, fake companies that are paying the friends and cronies of many politicians. And I think it works on both sides. I'm not just pinpointing the Democrats. They're just the ones that hate Trump for doing it more and are vocal about it. I think there's plenty of people on Trump's side that are not really crazy about what's going on either, because politicians are politicians and they use their influence and their power and their positions of authority to their own benefit. I think it's pretty obvious that that's always been happening. It's interesting that they're finally being transparent about it. Elon Musk and Trump, who are both billionaires and don't need money, are saying, let's treat the taxpayers' money like it's important, like it's theirs. And I think that's great. So that's the first unconventional thing I think we're dealing with. The other thing is, the big tariff deal. There's going to be some inflationary pressures right away. But, I had a guy, I was buying avocados earlier this week, and, I went up, get a couple of avocados to throw in my Mexican salad, what I call it, my burrito bowl, right, that I like to make. Anyway, the guy goes, better get them fast for those tariffs, double the price. And I'm like, how in the world is tariffs going to double the price? And I said, well, it'll probably help a lot of avocado farmers in California. He goes, what do you mean? He says, this tag here says Mexico. I said, right. I said, there's a lot of avocado farmers in California probably can't sell an avocado for 20 cents and make a buck. I try to give them an economics lesson. I said, a 25% tariff on avocados in Mexico doesn't mean if we're paying 70 cents for an avocado that all of a sudden it goes up to 25% of that, which would, push in a, 90 cent range. And I said, it's only on the price of the avocado that comes. I said, most food, what I've heard and read many times is that most of the cost of food is transportation. So if we lower the cost of energy and gas by enough to get 60% of the cost of food down by even 10%. So let's just say an avocado costs a buck at the store, but Mexico sells them for 20 cents a piece. And then they mark it up 60 cents for transportation. And then Walmart gets to make 20 cents. Well, if they raise the tariffs 25%, that means that 20-cent avocado is now 25 cents. So if Walmart sells it for 5 cents more to cover their costs, the transportation being all the same, then that dollar avocado goes up to $1.05, not, $1.25. So it's really not as bad. It doesn't filter through to the extent that, oh my gosh, 25% tariffs, everything's going up 25%. Well, that's not true, because most of the transportation isn't necessarily on the Mexican side. And by the way, they've got their energy costs already managed and controlled by their government. But here, if we can lower those costs and get the transports, from the border to all the stores, let's say we can save 5 cents on transportation, 60 cents if we can just save 10% on energy. In other words, if $3.50 diesel goes down to $3, well, guess what we just did? Or let's just say it goes down 10% to $3.15. Well, we just lowered the cost of transportation by 6 cents, which more than offsets the tariff of 5. So I think people don't understand really the ramifications of it. They think, oh my gosh, it's just going to be such an inflationary thing. And, poor Mexican farmers are going to be out of business. Well, not necessarily. They just have to, if they still want to sell them to us, maybe they drop the price to 19 cents or whatever in order to compete. But the cool thing is if a California farmer can make money selling avocados for 24 cents, but he goes underwater selling them at 20, guess what? Now the avocado farmer in California can make a penny an avocado. Now, I know that sounds ridiculous, but when you're selling millions of avocados, that's millions of pennies, and that adds up. So it's just an economics lesson that has to be thought through and understood from start to finish before you understand what it really means to the economy. Not only that, look at the extra jobs that now they've got California avocado farmers hiring more pickers, more transporters. They get to actually use the farmland for what it was built for instead of let it sit dormant because they can't afford to sell avocados. And I'm just looking at that as one example. I mean, there's big crops of nuts. Almonds are a big thing from California. Pecans, peaches, just anything that grows on trees pretty much. And everything that grows in a field is huge in California. So, think of the economy that they're missing out because we're able to import things. And in Mexico, you can grow everything pretty much cheaper because the cost of labor is so low. And, they control the cost of transportation and other things. So it's going to come back to help America. It's going to bring manufacturing. They talk about the average car. If you build a car in Canada and let's just say it costs $40,000 to build it, they want to sell it for $50,000, and all of a sudden now there's a 25% tariff on that. Well, now this car goes up to $62,000. So in America, we have to pay $62,000 for that car. And maybe you can get an equivalent car for $52,000. And they're going, oh, crap, we're going to lose the business. So guess what they do? They move their plant across the border to Michigan and hire all those people that are out of work that haven't built cars for a while because so many of the American-built cars have moved overseas because they can get cheaper labor. A lot of them have moved to Mexico. Now they're going to move back. They're going to build plants here. They're going to hire all those people in higher-paying jobs than they're getting now probably in order to reestablish facilities here. Guess what? Now they can sell their car probably. Well, what if they have to build their car for an extra $5,000? Well, they're still net ahead $7,000 based on the fact that they're no longer paying a tariff. And guess what? Jobs are prevalent in America now. More people have money. More people contribute to the tax rolls. More people contribute to Social Security, which saves the Social Security system. We have to bring manufacturing back. One of the biggest economic indicators of the state of the economy that we're in is an economic indicators index, and it's a leading economic indicator index. And for the last 30 months, like 29 of those months are down, maybe all of them, but they're consistently going down. And a big part of that is manufacturing, jobs growth, wage growth, and just different things like that, housing starts, lending, different things that, go into the economy. I think there's like 10 or 15 different levels. I don't even know what the list is, but the economic indicators is kind of an overall view of the key points that make an economy grow or contract. And right now, inflation is eating up all the GDP growth. We're not even really growing from the standpoint of getting bigger. Earnings are pathetic. The S&P earnings says, we're basing the S&P market, the stock market prices based on forward-looking earnings. Well, they've been forward-looking earnings at double or triple the earnings expectations is what's really coming in. When the stocks are growing by 20 or 30%, but earnings are growing by 1 or 2% per year on average of the 500 biggest companies in the S&P 500, it's a disconnect. It's a non-compute, and we're finally seeing that in market pricing. Now, I've mentioned for 2.5 years now, we're in an economic cycle that ends in a recession, that ends in a drawdown. There's 6 different bubbles that are popping at the same time. There seems to be an unreasonable or unprecedented amount of elasticity in these balloons or in these bubbles, which doesn't mean they're not bubbles. It just means they're still stretching. And when they pop, they're going to pop and probably pop even harder. We've got the yield curve inversion at uninverted in January. We've got unemployment going up, not down. We've got GDP stagnant. We've got private households owning more stock than they ever have before. That's considered dumb money, non-Wall Street insider money. And we've got insiders, people like Warren Buffett, people like the executives, Zuckerberg, Bezos, Jamie Dimon, all of which are just unloading hundreds of millions or billions of dollars worth of stock. Why? In order to take profits while the stock market's overvalued and high. Yet all the while, the person on the street is being talked into buying stock. We keep getting this cheerleading message on the news. Yet if you look at some of the leading stocks in the market, like NVIDIA, they're stagnant for pretty much 6 months. For the last 3 months, last month, last week, last a few days, it's down, down, down. NVIDIA is a leading indicator of the market. So we've got a lot of market turmoil, and a lot of that is, I think, rightfully so, because it's been overvalued for a long time. Now, back to your question about Trump and, what's going to happen is we've been in these cycles long before Trump got elected. In fact, these cycles started during his first term during COVID and started culminating in, it started actually showing their ugly face in 2022. But of course, the government learned that they could print money and the Fed could play shell games with money, give money to the banks in the back door, pretend they're taken out of the economy and continue to feed the banks money so that they can invest in stocks and do all their trading and dump their stock and make all kinds of gains by buying and selling. We've got so much, an unprecedented amount of debt, of delinquencies in mortgages, credit cards, things that have never happened before. In fact, the last time was even close to this high was during the last big market crash in '08, and had the same situation happen in 2000, where even though the market was going up, some of the economic factors were not, supporting that. So Trump is going to be the fall guy because I think he's misunderstood. The cycles were going to correct anyway. Some of the things that have happened just this past week or two, in fact, since the election, we got that little Trump bump. And we've been pretty choppy since then. There's been some good value plays in some stocks that are still making money and still growing that are great opportunities to buy, but you've got to be very picky because about 90% of the stock market over the last few days has gone down, not up. So there's very, very few stocks that are holding their own, and more stocks, including the big ones, the Mag 7, are falling like rocks now. Not falling like rocks, but they're definitely weak, definitely volatile, and it's definitely time for additional concern if you have a lot of money invested in the market. You never get hurt taking profits. Again, back to your question, Trump's economic changes are going to be great for America, and they're going to be even better because if the market corrects like it should and is due to, then we'll be starting with a fairly priced market and an economy that's better than it was a year ago or 2 years ago, or even during his first term, definitely better because he's going to bring manufacturing home. His policies are going to boost the economy, create more jobs, create more spending, creates more taxes because more people that make money get to pay more taxes. If more people pay taxes, even at a lower rate, the government raises more money for taxes and can do more things, can spread it out to those causes that make sense, that build the economy, that build infrastructure, and not just give money to crony companies that help give you money for your election or whatever that so many politicians do. It's just really a kickback game. I think this money will actually go to the American people. America will grow. The U.S. will be a strong nation, not just by reputation, but by truly economic fortitude. We will kind of regain, make America great again is a true goal of most Americans. That's why overwhelming majority of people voted Trump back in, because they know he's a businessman and can do some of the things that need to be done. I look forward to it. I know that's going to be probably rocky. It's going to be ugly. He's going to get the blame for all the bad things that happen because, the other party's going to, they can't make themselves look good. They haven't for many terms of presidency. All they can do is keep on trashing the other one and make them look like Hitler and a fascist and a bigot, Nazi, whatever. Then somehow they think they've got the upper hand. But the fact is the proof is in the pudding. Trump has plenty of women in high-powered places, plenty of multiracial assistants and right-hand people, always has. And so, none of the things that they say about him is going to hold water once people see, what really happens. And especially once the people that voted him in see that he does keep his promises, that he did what he said. And even a lot of Democrats are saying, wow, our party went way too far. Why do they keep on dogging on this guy that's fixing America, that's given us better jobs, that's given us more economy, that's keeping my tax rates down so I can keep more of my money? Even though we had a stock market correction and we're back to where valuations are normal and should be, from here on out, we've got a foundation that's been built by this president in his second term. Unfortunately, they're limited to 2. I think what he wants to accomplish in 4 years is an amazingly high and probably an unrealistic goal, but I think he'll get us quite a bit of the ways there. And I hope that whoever takes over after that doesn't just squash the momentum and limit it to these 4 years, because I think there's a lot more damage that's been done in the past that needs to be fixed. And bless his heart for getting up every morning and doing stuff. I've never seen a more active president in my life. It's exciting just to see all the new stuff that's happening. I don't think the world understands it. China's getting scared. Their stock market was doing really good up until a week or so ago. Now there's a lot of selling off and people are getting nervous. I think that money will start flowing back. Even the Chinese economy, even though it's propped up by their governor and manipulated to a large degree, I think they're going to see that as businesses get better in America, that Americans are still going to be willing to buy those products, even at a slightly elevated price, because that elevated price means that America's collecting tariffs, which can be deployed into other areas that will help businesses, that will help the infrastructure, will help our quality of life, and also offset some of the taxes that otherwise would have to be charged to us to keep America running, because we've got such a high level of debt. And hopefully they can get some of that under control.
You're listening to Premier Retirement with Jeff Logan, founder and president of Premier Retirement Planning, wealth management right here in Tucson, also up in Mesa. Again, if you got questions for Jeff, 520-780-9059 is our telephone number. If you'd like to get in and sit down with Jeff and talk about the Trump moves, how they may play into your plan for a confident retirement, again, Jeff would love to sit down and talk with you, answer your questions really about anything that has to do with growing your wealth or retirement. And again, our telephone number, 520-780-9059. You can call it this weekend if you want. All you got to do is leave your name, telephone number. Shelley will call you back during the week and set up a time for you to come in and sit down with Jeff. And again, there is no cost and no obligation for this. We call it the Premier Retirement Roadmap. And again, it's not going to cost you anything at 520-780-9059. Jeff, when I think about what Donald Trump has done, I think about a chess game. You know, when you make moves in the beginning, maybe your opponents don't quite understand those, but at the end of the game, and you have won, then it appears to be quite obvious why you made those moves. Would that be a good analogy as to what Trump is doing right now? People are not really understanding the chess game that he's playing.
Well, I think I alluded to that. My long answer is that they don't understand. I think they're going to see the proof will be in the pudding. The thing is I don't know if all that stuff can really be fixed in 4 years. I hope so. I think in 2 years, we're going to start seeing some massive changes. I think the market by then will be done with its correction. I think the economy will go into some sort of a recession, whether it be a soft landing, big landing, or whatever. You know, there's going to be kind of a slowdown. I mean, think of just, if nothing else, all the government workers that haven't really been working. There's a lot of stuff getting cut. Now, I think there's a lot of government workers that go and do a great job, and they deserve their salaries. They deserve their pensions. They deserve all the benefits they get because they take their job seriously. They believe that they're making a difference, and they go to work every day, and they actually accomplish stuff, and they are productive. But there's so many, we're finding out, so much waste that people are taking government jobs that aren't being supervised. They get to work out of their house, have maybe even a second job, get a paycheck from the government that isn't even justified. Now, those paychecks are going to be cut out. People think, oh my gosh, there's going to be so much unemployment. You know, as a taxpayer, I'd rather pay that person a third of what they were stealing from the government for not working for less, so that they'll be motivated to go get a job. And by the way, if they are those government workers that apparently have these side jobs, they've got a side job, and they've been able to sock away so much of my tax paying money, my taxes, and yours and everybody else's, that they should have a nice little nest egg and cushion to land on it. Now, I don't know if that's everybody, but I don't have sympathy for somebody that uses the government for a welfare check and pretends it's a job, or pretends they have a job, takes a welfare check, even though they're not on welfare, but still sucks the hardworking taxpayers' money, you know, out of the system and into their own pockets. I think it's fraudulent, it's rude, it's dishonest, doesn't have any sense of integrity or well-being or kindness or goodwill to it whatsoever. And I think it's rightfully so that those people should be out looking for a real job. And guess what? All the companies that are building plants here because they don't want to pay tariffs across the border of Mexico or Canada, or even in Asian countries that are moving assets here. Look at all the stuff that Apple said they were going to do in the U.S. Amazon, they're bringing all kinds of stuff to the U.S. because they don't want to pay the tariffs to bring it back into the country. All those people that had government jobs, they'll have plenty of opportunities to go to work at those places and make a reasonable living, but also one where you can be proud of working a bona fide paycheck, if nothing else, a respectable job, a respectable income. They actually give value and get a return with pay so that they can live nice. And I know some of those companies, in my opinion, really pay well. I mean, Amazon, I talked to some guys on a plane that are in just mid-management in their early 30s and the multi-six-figure incomes that they make. I mean, these companies don't skimp, and they hire good people, but they're willing to pay what they're worth, and they're willing to, I think, even overpay the market in order to have their big system not fail, because people aren't going to leave a good job. If they can be productive and get paid well, they'll stay. And I think these companies that are bringing production here, Apple included, you know, hires the best of the best, and people that will put forth effort, they pay well. Amazon, the Magnificent Seven companies, are not afraid to pay for good help. And those are the companies that are kind of leading the effort in bringing back a lot of those jobs that have been shipped overseas and have ended up being, you know, laid on the back of government to try to create jobs. I mean, you know, all those jobs that they created, the millions and millions of jobs the Biden administration created, 60% or more of them were government jobs that didn't add any services really as far as the supply of service in the government, so to speak. If you look at how much extra employees there was hired over the last 4 years compared to the additional production that the government was able to provide, I didn't see it. I didn't see any of it. All I saw was, oh, we created jobs. Look at this, people. We're using your taxpayer money. We're just basically doing a shell game or a Ponzi scheme, take it from the people that work and give it to the people that don't work. And at least they can pay taxes and buy stuff and get the economy going. That's kind of a fake economy and one that can't sustain itself forever. Just like a market that is looking for earnings that haven't happened yet can't stay out ahead of earnings forever. And that was very articulately said 2 weeks ago in the letter from Warren Buffett when he explained why he's got a third of over $1 trillion in cash at Berkshire Hathaway, because it just doesn't make sense to be paying as much for stock right now as we've been paying. And I think what we're seeing is a very healthy correction. We might even see a crash. We might even see so much misunderstanding of the Doge, letting people get back to work in the real workforce instead of in a gravy train where they get to sit at home and not work and get a paycheck, to actually being productive. I think it'll take a while to get them all back in the system, being productive, creating real jobs, creating income, paying taxes, and getting us out of the kind of a recessionary period that we'll likely go through. But, economists, experts, hedge fund managers, smart people, Warren Buffett included, and Ray Dalio, the people that Munger before he passed away, all these people that are famous for knowing about the market and knowing about the economy have all said we're in a reset period. There's going to be a recession. I mean, it didn't matter if Trump won or not. They still said it last year and they would still be saying it now. It's just a matter of when all the balloons start popping and we have to kind of deal with it. So it's no secret. In the meantime, we can try to be somewhat aggressive by making smart choices in the market if you want to be, or we can just sit it out and wait till it corrects, which most of our clients are doing because they're retired and they can't afford to lose money. I'd rather make a client upset for only making 5 or 6% in safe investments than losing half of their retirement money because, we knew a crash was likely to come, just didn't want to time it and keep throwing money out there at risk just in case. I don't want to do that. You've worked hard for your money. If you've worked hard for your money, if you have a nice nest egg, and if you can live fine on it without losing it, then that should be your plan. If you have plenty of pensions, plenty of income, and you can afford to ride the roller coaster and the risk doesn't bother you, then be in the market. We have a lot of people that are still in the market that are okay with the risk. Some are a lot more enthused about it after Trump's win. However, like I said, the bubbles are still getting a little bit more inflated and overinflated. We just have to be ready to risk off when the risk gets too high. And I think we might be there soon. I mean, we're staring in the face of market cycles and resistance in the market that we can't seem to get through right now. Big stocks like NVIDIA, who have kind of led the market. If NVIDIA goes up, the market does whatever NVIDIA does, and NVIDIA hasn't been doing well. They found out NVIDIA was backdoor selling chips to China when it was banned. That was banned under the Biden administration. Nobody really cared, but apparently they're finding out that there's been a lot of earnings that's been done by selling chips, which I would say is an illegal transaction. And I don't know if there's going to be sanctions or not, but I think maybe some of the more integrous companies that have kept the rules and kept their production out of China. And by the way, some of that backdoor chip sales from NVIDIA to China may be part of the reason that Deep Six came out and said, hey, look, we've reverse engineered all the stuff you guys are doing. And now we can do it cheaper. That's going to hurt all the chip companies. That's going to hurt all of America's tech companies. And there might be some heck to pay for that. NVIDIA might be the biggest loser. And if you've got a bunch of it, it's not a bad time to take profits. You're still getting out near the top. I have some clients that had way overloaded amount of stock in NVIDIA, and thankfully they got out in the last week or two and locked in profits close to the all-time high. I don't know when it'll be all-time high again, but I do think that if we just look at what's been happening to that big stock, and I'm not saying everything relates to NVIDIA, but if you look at all the Magnificent Seven, Amazon's falling, Microsoft hasn't done anything for a year. I don't think it's even up for a year. Apple's had a little run, but it's getting weak. Google, actually a pretty fair valued company, but it can't seem to hold water and go up. So, all these big companies that have really dictated what the market does are not dictating what the market's doing now. So I think there's definitely room for, caution. And I've been saying that for a long time. I think the ugly dragon's raising its head and we're able to see it a little bit more now. And I'm not the I told you so guy. I mean, because, everybody who's been in this business more than a few years and a couple of market corrections sees what's happening and it has known this. Sometimes we get a little greedy and we want to stay in the market a little too long, but you can never time those corrections. You can never time them exactly. They'll eventually happen and they'll catch most people by surprise. And that's usually when Main Street, the regular people, end up losing the most on Wall Street because they've already divested, and the big executives of these big companies have already divested billions of dollars of their holdings, aren't going to get hurt as bad. That's why the rich get richer and the poor get poorer, is because the poor are less informed. They're just trying to get on the ride at the right time. They get suckered into staying in there too long. They're the ones that get hurt the most. And, my job is to try to help the normal person, the middle-class person, the person that's worked hard, save for retirement, not get caught in that trap.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about Donald Trump's actions and how they may be misunderstood. If you'd like to come in and sit down with Jeff, talk about your individual situation, maybe ask those questions that we maybe haven't covered here on the radio program about Trump's actions and how they may apply to you, we're offering this retirement roadmap at no cost and no obligation to you. 520-780-9059 is our telephone number. As always, you can call it right now if you want. Leave your name, telephone number. Shelley will call you back during the week and set up an appointment for you to come in and sit down and talk with Jeff. No cost, no obligation, certainly no judgment. 520-780-9059. You can also find out more about us online at premret.com. That is PREMRET.com. Jeff, time for a break. We're going to answer listener questions and then later on talk about alternative investments when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
We so much appreciate you joining us each and every weekend for Premier Retirement here on 790 KNST. Of course, Jeff Logan with Premier Retirement Planning and Wealth Management. My name's Jeff Shade. If you have missed our program, we're on 4 times a week, Saturday at 7 a.m., also 9 a.m. and 1 p.m. We're also on Sundays at 11 a.m. And if you like podcasts, we've got a lot of shows up there. Go to wherever you get your podcasts, search for Premier Retirement with Jeff Logan. You'll find this show and all of our past shows so you can stay on top of your journey towards confident retirement. Again, our telephone number, 520-780-9059. If you'd like to get in and sit down and talk with Jeff about your journey towards retirement, whether you're planning to retire soon, maybe you're already in retirement, again, call us at 520-780-9059. Set up that casual conversation with Jeff to get your questions answered. You can also find out more about us online at premret.com. That's PREMRET.com. Jeff, every week we get listener questions. This week, no different. We'll kick it off with Paul listening to us in Tucson. And Paul says, a family friend, 91, wants to add me to the deed of his house. His wife died about 8 years ago. His daughter, who would be my age, 65, died when we were in high school. And his son is in no condition to get the house, unfortunately. Therefore, the family friend wants to add me to the deed. What is the best way to add my name so there are no issues upon his death?
Well, in Arizona, you can do a beneficiary deed rather than have you on the deed as a co-owner. I mean, the problem with having multiple people on a deed of a property is the person who lives there, that's a primary resident and typically is protected from Homestead Act and to a big degree lawsuits and things like that, because most judges won't take your house away unless it's got so much equity and nobody needs to live in a house worth $10 million or something like that. But if it's just, a normal house, like a normal place to live, and if you had to lose it and move someplace else, you had to pay the same amount for a house, you probably won't lose it. However, if you have other people on that house that aren't primary residents and technically they own a piece of it, a second property, a non-personal residence, I believe, I'm not a lawyer, so I'm not giving you legal advice, but my understanding, based on what my lawyers have told me, is more susceptible to a lawsuit, which could in fact affect the original owner. So the original owner, you can either leave it in trust and still own and manage all the rights and privileges to that house while that person's alive, and put the other people on as beneficiaries upon death. They can also put powers of attorney to where you could take care of that house if the person is invalid living in a rest home and maybe you want to rent it out or take care of that asset because it's in a trust and you're the trustee. The other thing, if you don't want any problems or any responsibility of the house until he passes away, then you can just use a beneficiary deed where you can file a deed that says, hey, when I pass away, this house belongs to this person, that person, the other person. You can put multiple people on as beneficiaries. And then at that point, the beneficiaries, whoever it be, you or you and other people, would be all listed as equal owners on that property. So typically, if that happens, if there's multiple beneficiaries, then typically the house is sold and the proceeds are divided through the escrow account, through the title company, typically on a proportionate basis. You don't have to actually have equal proportions. If it's not listed, then it's assumed equal, but you could have half the house belongs to so-and-so and a quarter of the house belongs to so-and-so and another quarter for this person. But that's one way to get around having to do a full-blown trust, having you add additional liability to the homeowner during their lifetime. And one thing that I would consider in that regard.
So, Jeff, if this person is added to the deed, Would he lose the step up in basis? Maybe he bought this property 50 years ago. Let's say that he paid $500 for it and it's worth $1 million. Would he lose the step up in basis if he is put on the deed?
Yeah, that's a good point. I kind of jump right past that, but that's another thing. If you put one person on the deed, you're essentially giving away half the house while you're alive. That half would not receive a step up in basis and would have to go back to the original basis he paid. So let's say the house is worth $500,000 now and he paid $100,000 for it. Gives half to you right now. So basically, you have a $250,000 interest in the house and a $50,000 basis. If you sell it, you still have to pay tax on the $200,000 gains. Whereas if you use a beneficiary deed where you inherit it through the deed upon death only, then you get a step up in basis on the entire amount. You don't have to actually be an occupant or primary resident of that house in order to get the typical exemption on taxes on the sale of a personal property. So when you're inheriting property, it's nice to get a step up in basis, especially if he's 91 and the days or years are more likely numbered. I'd definitely use a trust or a beneficiary deed for even the tax reasons, probably being actually even a bigger one than the potential of lawsuits, liabilities, and other things.
Paul, thanks for listening to us in Tucson. And again, if you want to sit down and talk with Jeff, our number 520-780-9059. We'll also be sending you out Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is David listening to us in Rancho Vistoso in Oro Valley. David writes, what are your thoughts around indexed annuities with a guaranteed downside protection? I'm considering investing about 20% of my IRA assets into an annuity that is tied to the S&P 500. It guarantees 20% downside protection, has no explicit fees, and pays out in 6 years. This is long-term money that I don't have to touch for many years. What is your opinion about this?
Well, that's more or less a buffer. That's a variable annuity version where they're trying to give limited downside risk for a little bit more upside protection. I'm not sure I'm into those. If you have 20% downside protection over the next 6 years, I've never seen a time in history where you'd be down 20% in 6 years anyway. But what if instead of having kind of a buffer where if it goes down 20, you could actually lose 20 up to 20% in value and have to build from there if the market corrects big, rather than something that might give you less upside. Let's say you get 12% on the upside on that one that gives you a 20% buffer. Well, if the market goes down 40%, you lose the 20%, but you lost 20 instead of 40. Okay, well, that's good that you didn't lose 40. But on the upside, let's say you would have made 12. On the other hand, you could have one, I like the fixed indexed annuities, where you don't lose any money. So if the market goes down 40%, you don't lose any money. But on the way back up, you might make 9% as a cap or 10% on the upside of the stock market instead of 12 or 13. Okay, well, you never lost any money, so it resets at that point. Now, on the buffer, there's two ways that those work. One is that it could reset you 20 below value, but that's your new value. And then you make 12% from there, which means it'd take you 2 years just to get back to even roughly. Whereas the one that doesn't go down at all is first year it makes 10% or better. On the rebound year, then you're at least up 9 rather than waiting till it catches up. Now, the other option is your value technically may still be, let's say it was $100,000. Instead of going down 20, maybe that buffer is only guaranteed at the cash in time. But if it's down 20, you still have to make up, the market still has to make up that 20 before you start making that 12 cap. So if there's one bad correction in the next 6 years, you probably offset any of the gains that you would be losing by just going traditional fixed index, meaning safe index with no downside risk, and still have most of the upside that those other buffered annuities would give you. Buffered annuities are in the variable category. Variable annuities are very expensive. I think, honestly, they're a ripoff. There's what's called mortality and expense charges. There's fees built in that you might say that there's no apparent fees. There are some fees. And if the fees aren't expressly noted, they are built into, read all the pages of the prospectus that comes with it, and you'll see that there are fees built into it, but they might be sort of stealth. In other words, they might be factored in before the credits are actually paid. And I just don't think that if you're really worried about risk, get a zero downside potential and still really good upside. Right now, there are high interest rates compared to 5-6 years ago. You can get a lot of upside in fixed index with no risk. There's also companies that give you a nice little bonus to start with. You might make a little bit less on the upside, but if you want a kicker to get out of the gate with, there's even some bonus annuities. There's other annuities that aren't tied necessarily to the S&P, but are leveraged. Maybe you can make, instead of making, say, half of the upside of the S&P 500 or a cap of 12 or 13, what if you could make twice an index that averages 6? But that index that averages 6 is not tied directly to the stock market. It's tied to a variety of different things. You know, if Trump does his business the way he says he's going to do it, I think there's going to be these indexes that have multiple indexes involved that are going to be rebounding because they've been stagnant for so long. There's probably some good upside. So what if you could double or triple the return on one of those indexes or diversify between the S&P and those other indexes? There's a lot of ways to skin this cat. There's 2,000 insurance companies, more or less, that are admitted to Arizona, and probably at least half of those do some kind of an annuity, and probably a third of those do some sort of an indexed product. So when you think of all the options that are out there, you can find one I think will give you the best of both. But if you buy them through a broker dealer, they have to have enough commissions for the rep that sells it, for the management on top, an ongoing fee to make them, happy about it. And that's typically what those buffered annuities under the variable category would do. We're independent. We don't have to pay a broker upside above us or have ongoing fees. We either have ongoing fees or we have a commission. We don't have all three of those levels of payments taken out of the products that we use. So again, just consider the options, kick it around, check with your broker dealer on the facts, compare it with some of the fixed index annuities that we like, and you make your own decision.
David, thanks for listening to us in Rancho Vistoso. Of course, give Jeff a call if you want to continue this conversation. 520-780-9059 is our number. Also, you can go out to the website and check us out at premret.com, premret.com. We'll also be sending out Jeff's book, Retirement: The Road Ahead. Jeff, next question is William listening to us in Vail, and William says, I'm 54 years old and am looking to diversify my long-range portfolio. Most of my wealth is in stocks, bonds, and cash. My mother recently passed away and blessed me with a substantial sum of cash, $600,000. I'm looking at investing in real estate, but do not want to actively manage properties. Could you tell me the pros and cons of investing in REITs versus private crowdfunding platforms such as Fundrise or CrowdStreet? I understand that liquidity is one aspect of it, but are there others that I should consider as well? Love the show, and thanks.
Well, I think if you're going to look at REITs, if that's really the way you want to do it, I would look at publicly traded REITs, not a new REIT where you go in hoping that the company invests your money wisely, using your money and everybody else's money to pay interest on the REIT as it gets funded, and then hoping they can somehow sell those properties at a profit or take it public later. Those REITs are typically a loser game. They typically pay good commissions up front, and most of the time the people get their money back at best, would be better off waiting for it to go public, waiting for the actual market value to take place, and then buy and sell them. So depending on how you want to go about it, look at those. Are kind of like a private equity type of function in a way, with just a bunch of real estate, either holdings or loans that generate cash flow. It could be apartment buildings, houses, different things like that. The nice part about REITs is they're very diversified and typically are a little bit more steady. However, when things like COVID happen and half the real estate in the portfolio doesn't collect rent, or even are prohibited from collecting rent because the government says you can't collect rent, you can't make these people homeless, sorry, you're on the hook for that, then you're going to take a beating. And if you want to sell, you can lose money in that kind of a thing. So I understand you not want to manage it. That is a job. And if you don't want a job, then, don't own real estate. You can hire management companies. I haven't personally, I've tried it a few times and I've never liked the management company. They've never done a good job for me. They've let things go more negligent than I would have and got to things a lot slower than I would have and charged me more than I would ever had to pay. So I know there's probably some management companies out there listening like, no, we're honest. We would never do that. Well, I haven't found you. So call me next time I own a real estate property. Then I'm sure they're out there. I just don't know them. And the other thing you can do is do some hard money lending. I do that with a lot of my real estate money. I don't really want the immediate liquidity, but I'll give a guy who's doing fix and flips a loan for a year to fix and flip his property. And I either own the house if he doesn't finish or pay me back in time, or I make 10 or 12% on my money. I don't have to manage anything. I just put a lien on it. So, there's some things you could do if you look around for private parties that might do some individual business with you. I'm actually thinking, once my son comes aboard, Taylor, he's a CPA, he's not aboard full-time, he works for me part-time because he's actually managing real estate. Hopefully one day he'll build us a private REIT, so to speak, or a private real estate portfolio that we can build and share the gains on the notes that we're able to buy, that we have connection all over the state with, actually, where we can loan money and get much higher rates than a typical mortgage because these people either have so much property that they can't get debt because they think they're high risk. Well, guess what? You get higher rate of return and you still get a lien on the property. So you still have secured assets. So there's some different ways to play the game. I hope to be able to say online when I get a question like this that, hey, we have an offer and you might like, but that's probably, days or months away, maybe a couple of years, but fairly close around the corner. Meantime, you can look online, maybe do some research. I am not familiar because I do private lending. I'm not familiar with what you can buy in the real estate market out there other than your own portfolio of real estate. So that's really not my forte, unfortunately. I'm comprehensive, but I don't know everything about everything.
William, thanks for listening to us there in Vail. And of course, if you want to talk to Jeff, 520-780-9059. We'll also be sending you out Jeff's book, Retirement: The Road Ahead. Listening to the program today with Jeff Logan, you've got a question for us. You can get it into us by calling Shelley at 520-780-9059, or you can go to the website, primret.com, use the contact page there. If we use it on the air, we'll be sending you out Jeff's book, Retirement: The Road Ahead. Meantime, if you do want to download the book, you can do it right now. Go to primret.com, look over there in the resources page, and there's going to be a tab for that book, Retirement: The Road Ahead. Listening to Jeff Logan of Premier Retirement Planning and Wealth Management. Glad you could join us here on this weekend on 790 KNST. Jeff, let's move on to our next topic now, which is going to be about alternative investments. Jeff, beyond cash, stocks, bonds, things like that, there are alternative investments, things such as real estate, private equity, venture capital. So I thought we would talk about those a little bit and see whether or not they would belong in someone's portfolio. Let's start with real estate, physical properties, real estate investments, trusts, REITs. I mean, you talked about owning different types of properties and active management versus passive management. Is there an upside or a downside to owning real estate, and what would be both of those sides of the story?
It kind of depends on how you want to own it. A REIT, if you own a rental property and you use it part-time and Airbnb it out sometimes, you can typically find a way to depreciate everything you collect in rents and can kind of live tax-free on that money. You also get a capital gains tax treatment when you sell it eventually. So you can really change ordinary income, taxable income into capital gains taxable income at a lower rate and maybe enjoy a property, a second home or something like that. That's one way. That's my preferred way, actually, to own extra properties and still have somebody kind of look after them, have them not sit unused, but be able to enjoy the depreciation tax breaks and the appreciation eventually when I sell them. You can buy REITs if you just don't want to manage anything and you just have to kind of take your chances on what kind of pass-through taxable benefits there might be. Some have some and some don't. Some will pass through, like a limited partnership type thing. And some private equity sometimes will have a pool of loans or funds or properties that generate income that also are offset by the depreciation that they can take. So you could get some maybe tax advantage income or tax advantage appreciation on some of those type of products. There are some private equity, typically private equity likes you to have millions of dollars in order to play the game. In order to invest in private equity offerings through a registered investment advisor or broker, typically you have to be an accredited investor, meaning you have to make at least $250,000 a year or have at least $1 million in liquid asset net worth to invest. I think that's been the level forever, and it's a lot easier to hit now. Just about everybody who's worked a little while and saved a little while has that. But as an accredited investor, maybe you only have $1 million or $2 million, and you don't want to put a whole $1 million in one of these investments. You don't have to. There are some private equity firms that will create. For example, our company is involved in a relationship with 500 other independent offices nationally. And as we pool our investments and have somewhere in the neighborhood of $120, $130 billion in assets, including insurance, annuities, management money, and so forth, it's in the billions. So we have enough clout that says, hey, a private equity firm, if you can carve us out $1 billion of your private equity and let us offer it in small pieces to all of our clients, we would really appreciate it. And so they'll actually set up a private offering agreement and give us our own ticker. So we'll have our own ticker symbol for that particular fund. There are companies like ours that do that individually. Like I mentioned, we'll eventually have one that's a premier real estate fund. Outside of that, we have access to real estate funds. Blackstone and BlackRock have some things that are, kind of touted, are pretty mainstream that you can get anywhere, just logging into Fidelity, Schwab, or anywhere and just buying it. Again, do your homework, make sure you know what the benefits and the drawbacks are. There are some that own assets outside the U.S., and there's a certain K-1 that you'll get that you have to disclose foreign property investments, and it's a pain in the rear, so you might not want to go down that route. Bottom line is there's a lot. You should know what you're getting into before you get into it, but there's such a variety of different things that you can get into. Don't make yourself sick about it. Decide if you want to do it first. There's another one I didn't mention. It's a DST. Many people use them for a Delaware statutory trust. Many people use them to 1031 a property into that they've sold. Maybe they own an apartment complex worth $10 million. They don't want to pay tax on it because it's depreciated to zero. They can roll it into a diversified portfolio of properties similar to a REIT, but you get the growth, you get a rent check, the depreciation passes through, and you can piggyback on that as a first-time buyer. You don't have to have property to roll into a Delaware statutory trust. Some of them are actually offered, to the public, if you have a certain minimum account balance. Sometimes they're commission-based, but typically they're fee-based on the registered investment advisory side. So again, lots of opportunities, and many of these that I've just mentioned aren't available if you just call your 401k company and say, hey, can I add this to my product? They'll say, huh? We don't know what that is. So again, if you're looking at that kind of a thing, it'd probably be good to work with an independent advisor that has access to multiple products, product categories, contacts that can broker these products to you if you're interested in looking at a wide variety of things.
Jeff, there seems to be some interest in things like gold, silver, precious metals, and Bitcoin. What do you think about those as alternative investments? Are they more speculation than investments?
Not necessarily more speculative. They're still speculative. If you're looking at Bitcoin, I mean, that's something that has really no value other than what the next sucker's willing to pay for it. And I've said that before. Doesn't mean it's a bad investment, meaning could you put money in it and make money? Yeah, you could, but for every person that makes money, somebody just lost the appreciation that you got. It starts at zero, right? I mean, they say, oh, it costs so much money and power and energy and to mine Bitcoin. Well, maybe it does a little bit, but still, if you can turn a computer on and have it make a supposedly unhackable password through an algorithm and it spits out a code that says it's money, that's money printing. That means the Fed has competition. And I'm really not sure why the Fed has allowed it, because it's part of the inflation problem. If you let private citizens create money, then that's money that's typically not taxed. It can create higher prices. So the people that actually have real dollars, which I know some people, fiat currency, it doesn't have value anyway because it's unlimited supply. They can print it anytime. Well, so if you can print Bitcoin anytime, they say, oh, well, there's a limited supply. We're not doing any more. Get Bitcoin. Really? Interesting. Is that true? Well, maybe it is, maybe it isn't. How would anybody know? Okay, well, they don't have Bitcoin anymore. Now they have, Ethereum or Dogecoin. They have different coins, but all these different coins that come up add problems, in my opinion, to the whole monetary supply. And it's probably the biggest reason that we haven't had some sort of a reset or an economic slowdown yet. And why these bubbles continue to still fill with air is because there's no real supply and demand issue that can be solved. So I think from the standpoint of Bitcoin, absolutely speculative. There is no value in the asset other than what somebody will pay for it. Now, gold and silver, on the other hand, have done very well, 20, 30, 40% returns in the last year or two, and hitting all-time highs in the price of gold. I think they're all-time highs. In my lifetime, I haven't seen prices this high. I'm glad I own a bunch of gold. I'm glad I bought a bunch before the election and a bunch last year and the year before. Yeah, I didn't think it was a big deal. It was just, okay, another diversified asset that I could own, some of it which I keep in my safe and some of which I keep in a portfolio through ETFs. Many of our clients like the idea of precious metals. The thing is, they can go down 20 or 30% over a period of time too. If the stock market gets good, if the dollar starts increasing in value. Right now, the dollar's kind of weakening in value. I think part of that is just because of the perceived weakness in the economy through tariffs, inflation, and the potential of adding some sort of a digital currency to the mix. So people are really unsure about the dollar and the dollar value. So gold and silver are that's kind of the makeup plan. So we've been really lucky to be hedging in that regard. The clients that have wanted to go down the road have done really well. And typically in a growth portfolio, I'd like 10 or 20% in that kind of exposure anyway, right now especially, maybe even more if that's all the exposure you want to the market. It's probably the best chance with upside going into what it looks like we're going into, looking at the last few weeks of the market, looking at the misunderstandings about tariffs and the market forces. But there is no misunderstanding as far as the market cycles that we're in, as far as the inflation that we're experiencing, as far as the unemployment that's growing, as far as the manufacturing and production that's down, the producer price index that went way up. Producers are paying, I think they said 6% more, if I'm not mistaken, that number. I'm not seeing, I'm not seeing the picture of it in my mind. I think it was 6 on an annualized percentage of 6. So producers are paying a lot more for goods, which is going to factor into what we're paying for goods very shortly. One of the big inflation hedge is typically gold and silver. And the thing with that is not only is it an inflation hedge, it is really about what somebody's willing to pay for it, but there's actual value. Some people use the actual value by wearing it on their fingers and necks and jewelry. Other people use it in electronics. All those precious metals are precious in the fact that they provide an incredibly important purpose, have an incredibly important purpose, especially when they're applied in the technology industry. They all have high melting temperatures, better conductivity than typical wires and stuff. With they can use them for alloys and different things that make us able to make chips that are so microscopic in nature we would never believe we could have as much power in something you can hold in the palm of your hand as we do now. That we used to feel something that you can hold, that takes up a fraction of the palm of your hand, does more work than a room full of computers that sent the astronauts to the moon. If you believe in that, I don't know if it is true or not, but supposedly went to the moon. I mean, it took computers, massive computers to do that. Now hold on that. You know why? Because we have precious metals. We learn how to use them and make alloys out of them so that they can actually conduct electricity and, make that binary code work and create output that process information like we've never been able to do before. So there actually is a value to precious metals. So I'm a lot more hip on that kind of a thing as an investment than I am, some Dogecoin, Bitcoin, or some meme coin that's named after Trump or somebody else and has, in my opinion, absolutely no purpose other than, suckering somebody out of some money.
Jeff, unfortunately, I hate to cut you off, but we're out of time for this week. Once again, our telephone number, 520-780-9059, if you'd like to get in and sit down and talk with Jeff. As I said, Jeff, out of time for this week. Thank you for your time, but most importantly, I want to thank our fine people listening to us here in the greater Tucson area. For Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here on 790 KNST, Tucson's most stimulating talk, with another edition of Premier Retirement.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.